FORA.tv. The world is thinking.
People recently have begun to ask, what are the banks doing with the money we've invested in them? We designed important features into our investment contracts to limit what banks can do with the money. 1, we restricted dividend increases and share repurchases. And 2, we placed important restrictions on executive compensation. By increasing a bank's capital, the bank will have strong economic incentives to deploy the capital profitably. Banks are in the business of lending and will provide credit to sound borrowers whenever possible. They may also use the capital to absorb losses as part of loan write-downs and restructurings. If a bank doesn't put the new capital to work, earning a profit or reducing a loss, its returns for its shareholders will suffer. What about mergers and acquisitions? Why didn't Treasury prohibit them? We must remember that when a failing bank is acquired by a healthy bank, the community of the failing bank is better off than had that bank been allowed to fail. Branches and financial services in that community are usually preserved. Costs to the taxpayer via the FDIC deposit fund are also lower than had the bank been allowed to fail. Prudent mergers and acquisitions can strengthen our financial system and our communities while protecting taxpayers. So people then ask, when will we see banks making new loans? It is important to note that over $60 billion of the $250 billion capital purchase program has yet to be received by the banks. Treasury is executing at rapid speed, but it will take some time to review and fund all of the remaining applications. This capital needs to get into the system before it can have the desired effect. In addition, we are still at a point of relative low confidence, both due to the financial crisis and due to the economic downturn. As long as confidence remains low, banks will remain cautious about extending credit, and consumers and businesses will remain cautious about taking on new loans. As confidence returns, we expect to see more credit extended. Now, this reduced demand for and provision of credit is common in an economic downturn. During the past 9 recessions, inflation-adjusted total private sector lending per quarter has contracted on average 30% from peak to trough, while GDP has contracted 2%. So we should not be surprised that lending and borrowing will be lower during this current economic downturn. We absolutely need our banks to continue to make credit available, especially given the disruption in the non-banking financial markets. Our bank's role as provider of credit in our economy is even more important now. But we must not attempt to force banks to make loans whose risks they are not comfortable with. Bad lending practices were at the root cause of the credit crisis. Returning to those practices will not help end the financial turmoil. People have then asked, well, how will we track lending activity? Treasury has been working with the banking regulators to design a program to measure the activities of banks that have received TARP capital. We plan to use quarterly call report data to study the changes in balance sheets and the intermediation activities of institutions that have received TARP capital investments and compare their activities to institutions that have not received TARP capital. Now, because call report data is infrequent, we also plan to augment that analysis with a selection of data we plan to collect monthly from the largest banks we have invested in for a more frequent snapshot. The provision of credit that is vital to our economy will not materialize as fast as any of us would like, but it will happen much faster as a result of having deployed resources from the TARP to stabilize the system and increase capital in our banks.